In today's episode, we'll break down two important stories. First, we'll talk about India's biggest office REIT being its narrowest bet, and then we'll talk about India's bittersweet conundrum. Welcome back to the Daily Brief by Zerodha, where we cut through the noise to help you understand what's actually happening in the most important stories from business and market. Coming to the first story. So the Indian markets are about to see another major REIT IPO. Bagmane Prime Office REIT opens for subscription today, the 5th of May, and closes on the 7th. The entity plans to raise Rs 3,405 crore at a price band of Rs 95 to 100 per unit, sitting on a portfolio worth roughly Rs 40,000 crore. By size, that makes it the largest pure-play office REIT to ever list in India. If you're new to REITs or want a refresher on what they actually are and why they're different from buying a real estate stock, we covered all of that when Knowledge Realty Trust went public last August. The two issues are very different in substance though. Knowledge Realty was a diversified bet with 29 assets across 7 cities, deliberately spreading risk. Bagmane is the opposite. On paper, India's biggest pure-play office REIT sounds institutional and broad, but in reality, it's an exceptionally narrow bet. All of its revenue comes from just 2 corridors of a single city. Most of it comes just from 3 buildings, and nearly all of the rent is paid by foreign multinationals running their offshore operations out of India. So is that narrowness a moat, or is it a single point of failure? If you're looking to invest in this IPO, that's the question you must answer. And that answer turns out to be more complicated than either side of that question suggests. Concentration is usually a dirty word in investing. One of the first bits of advice any investor gets is spread your bets, don't put all your eggs in one basket. But is there a reason Bagmane's extreme narrowness could be a feature rather than a bug? So it comes down to the kind of corridors Bagmane has chosen and the kind of tenants those corridors attract. India's national office vacancy is around 15.2%. Hyderabad's is 25.7%. More than a quarter of all high-quality office space there is sitting empty. Contrast that to Bagmane's 2 corridors. The first is Bengaluru's Outer Ring Road, which has just 4.1% vacancy. The other is SBD City with 5.4%. These are hot properties, in other words. When demand outstrips supply this dramatically, landlords get something rare in Indian commercial real estate: pricing power. So JLL forecasts that ORR rents will grow 5.2% annually through CY28, while SBD City rents shall grow at 6.5%. These are micro markets that far outpace India's broader real estate. When it comes to tenants, meanwhile, there's a little quirk in how Indian office leasing works. So when a company leases an office in India, the landlord hands over a bare shell. The tenant has to build everything inside themselves: cabins, wiring, cabling, cafeterias, server rooms, labs, etc. This typically costs them 3 to 5 years worth of rent. Compare that to the US or Europe, where landlords typically themselves fund roughly a quarter of fit-out costs themselves. Now this might sound like a small accounting detail, but think of what it means. Indian office tenants are extraordinarily sticky. So imagine a company that has spent 5 years' rent equipping a campus the way it wants. Walking away, especially to save a bit of rent, is plain irrational. So most tenants stay and renew. Often they even expand within the same campus. Just see Bagmane's numbers. Between FY23 and the first 9 months of FY26, the company leased 7.2 million square feet. 91.7% of that went to existing tenants expanding their footprint. New tenants contributed less than 9%. Add this to the fact that approximately 43% of Bagmane's completed area is built to suit. That is, the building was custom designed for a specific tenant's requirements. And there, the stickiness runs even deeper. The bull case then is this. Bagmane runs in office-staffed micro markets where rents have nowhere to go but up. It caters to tenants who can't easily leave because they've sunk too much into their fit-outs. Their average lease runs for 7.4 years, and when those leases come to an end, most renew them for around 15% more rent. That narrowness, in other words, simply ensures reliable cash flows. But there is a trickier side to this. Bagmane's portfolio is 98.8% full. There's almost no empty space left, and the amount of cash the company is bringing in is about as much as it'll ever get. That raises awkward questions for a company about to ask the public for money. In a normal, growing REIT story, low occupancy is precisely where the headroom for growth comes from. You buy a 70% full building, for instance, and your revenue growth comes from filling the rest. Knowledge Realty, for instance, listed at 91% occupancy. It's been steadily filling its remaining space, which fuels a meaningful chunk of its growth. But Bagmane doesn't have that lever to pull. Its own projections assume that leasing vacant office space will contribute just 1% of growth until FY30. Not 1% per year, by the way, 1% total over 4 years. So, what then are they even promising? About 30% of their promised growth comes from contractual rent escalations baked into existing leases, and another 8% comes from mark to market, that is, by releasing old expiring contracts at current market rates. A small 3% comes from other, but most of that growth, 58%, comes from buildings that don't fully exist yet. So if you're betting on this REIT, then 3/5 of your bet is plagued by execution risk. Now, Bagmane has roughly 1 million square feet of office space under construction. It's marked out twice as much as its future development area, and it's coming up with 2 on-campus hotels and a solar plant. The company's total planned capex over the coming years is rupees 31,620 crore. So to put that in perspective, it's roughly twice the company's FY25 cash from operations and is well over the net debt currently sitting on the company's books. Now, this isn't a fatal problem. Developing new properties can create enormously amounts of value, especially if those buildings get pre-leased at attractive yields and the sponsor, Bagmane Group, has a long track record of building successfully in Bangalore. But make no mistake, you're currently buying promises. So if you're investing in a REIT, chances are you want bond-like predictability. Bagmane offers that predictability in its existing 98% occupied portfolio. But bolted onto that is a development arm, 2 hotel projects with very different economics from office leasing, and a solar capex story. Let's pause on those last 2. So the hotels being built directly on the office campuses are pitched as a natural amenity for the corporate tenants next door. Their tenants' hospitality needs, the pitch goes, will be absorbed by the campus itself. Fair. But hotels and offices have very different economics. Office leases are long and rent is paid monthly. Hotels rent rooms by the night at prices that swing with cycles. Even their costs are higher. Bagmane will need to sign on an experienced hotel operator, ramp up occupancy from 0, and absorb operating losses before they take off. Even the solar story has its quirks. Bagmane operates a solar plant that supplies green power to its tenants, and it's now doubling down. So instead of buying power from the grid, their tenants could get their electricity from Bagmane itself. Again, it's an interesting pitch, but one without the long lease economics that make the office portfolio look so steady. In fact, their solar offerings, which are, to be fair, just approximately 3% of revenue, are affected by all sorts of things, including BESCOM tariff revisions. There's also a financing wrinkle. So Indian REITs are required by SEBI to distribute at least 90% of their distributable cash to unit holders every year. So they can't easily retain money to fund all this development themselves. They have to borrow. But that isn't the worst thing. Bagmane's existing balance sheet is conservative, with net debt at just 7% of portfolio value, well below most listed REITs. But almost all of its current borrowings are on floating rates. And that introduces a whole lot of uncertainty. 100 basis points move in interest rates shifts its profit before tax by about rupees 38 crore. That's manageable today. But if the development plan needs significant additional debt, and chances are that it will, that risk could multiply. So the cleanest way to think about Bagmane then is as a hybrid. It has an existing portfolio, choice properties that bring bond-like stable incomes, but they have a pipeline that's much more equity-like and depends entirely on execution. The IPO is asking you to pay a price that values both. Of the 3,405 crore rupees Bagmane is raising, 2,390 crore rupees is a fresh issue. That's the money that flows into the company to fund the acquisitions of Luxor and Bagmane Rio, 2 assets being added to their portfolio. The remaining 1,015 crore rupees is an offer for sale, which is money that will flow into existing investors, taking some chips off the table. And that isn't abnormal for a REIT. Its valuation is interesting. And it is conventional in some ways. At the upper price band of rupees 100, Bagmane's implied market cap is roughly rupees 34,000 crore. Its portfolio's gross asset value is around 40,000 crore. That is, the IPO is being priced at about a 15% discount to the value of its assets. And that's broadly how listed Indian office REITs trade in the secondary market. But the projected distribution yields are higher. That's their estimate of how much cash you will get back as an investor if you invest in the IPO. Now, Bagmane is guiding around 6% in FY27, climbing toward the mid 7s by FY30. Embassy Office Parks REIT, the granddaddy of Indian REITs with 7 years of listed history and 27 quarterly distributions behind it, currently offers a lower trailing yield. So does Knowledge Realty Trust. That gap creates an obvious question. Why are IPO sellers leaving such yield on the table? There is an optimistic view. REIT IPOs in India are typically priced to attract subscribers because the asset class is still building its retail investor base. These premiums are just a sweetener so that the deal goes through. But the more skeptical view is that those projected yields rely heavily on the development pipeline coming through on schedule and at expected numbers. They project a growth of distributable cash of 20%, and chances are they're leaning heavily on a part of the business that hasn't been built yet. If so, the sellers may have a clearer view of that risk than buyers do, and they're pricing it in despite higher projected yields. The truth is probably some mix of both, but we certainly don't know the right answer. Bagmane's assets are genuinely good. Their campuses are scarce and sought after, their tenants are blue chip, the cash conversion is clean, the balance sheet is conservative. None of that is in dispute. But are you being asked to pay for those quality assets, or are you paying for new assets which could be just as good but come without a guarantee? REITs, much like most investments, are only as good as the price you're paying. Even excellent assets can produce mediocre returns if the entry price already assumes a best case scenario. We go through tons of investor presentations and reports while researching our stories. So we thought, why not compile the best infographics, charts, tables, and slides into one newsletter? That's exactly what we do in Points and Figures, a weekly newsletter we send out every Tuesday. Link is in the description. Coming to the second story. For most of the last 30 years, the number that Indian agriculture ministers dreaded was sugarcane arrears, the accumulated unpaid dues that sugar mills owed to the farmers who grew their raw material. In bad seasons, this number would swell into the tens of thousands of crores. Farmers would protest, politicians would scramble, state governments would announce emergency packages, and then it would happen again the next bad year. The arrears cycle was so persistent and so politically explosive that it stopped being treated as a solvable problem and became instead a permanent feature of Indian agricultural life. Then somehow it was solved. In the 2023-24 sugar season, Maharashtra, which produces a third of India's sugar, recorded cane payment arrears of just Rs 54 crore at season close across more than 200 mills in a state where total dues to farmers that season ran to Rs 36,699 crore. Every farmer who grew sugarcane in Maharashtra in 2023-24 got paid on time. The problem had ceased to exist. But then, by early 2026, the arrears ballooned up to Rs 4,252 crore, with 168 of 206 mills yet to clear their dues to farmers. By March, the number had climbed to nearly Rs 5,000 crore. The problem that had never been solved came back roaring, larger than ever. Then, in April 2026, the Indian government published a draft law that would replace the rules governing the sugar industry that hadn't been substantially rewritten since 1966. On the surface, it reads like routine regulatory housekeeping. But look more carefully, and what you find is the government encoding a specific economic thesis into statute. So the new law validates the thesis that a sugar mill is not a food company, but an energy company. And this reclassification is also a hopeful attempt at solving the arrears problem of Maharashtra and other states. So how did we get here, and is the new law a step in the right direction? That's the story we'll be diving into today. So sugarcane is one of the most politically sensitive crops in India, with around 5 crore farmers and their families depending on it. Sugar mills, which are the only buyers of cane within the farmers' assigned territory, hold enormous structural power over the farmers who supply them. A mill that delays payment or simply refuses to pay the full amount leaves the farmer with little recourse. So, the 1966 Sugarcane Control Order was designed to sit between both parties. It required every sugar mill to pay farmers a minimum price or statutory minimum price within 14 days of receiving the cane, with interest penalties for delays. In 2009, it was renamed the Fair and Remunerative Price or FRP, and its calculation was tightened to account for farmer input costs, returns from alternative crops, and a guaranteed profit margin. In 2013-14, the FRP was Rs 210 per quintal. For 2025-26, it stands at Rs 355, and it's rarely gone down. This is where the trap lives. See, the FRP is a fixed cost that mills must pay regardless of what sugar actually sells for. And because the price is guaranteed, farmers have little reason to reduce cane acreage when the market turns. They grow it anyway, mills crush it anyway, and sugar piles up faster than the country can consume it. India has long been a structural sugar surplus economy precisely because the price guarantee insulates farmers from the consequences of oversupply. But those consequences don't just disappear. Mills bear them. In a bumper year, production surges, sugar prices fall, and mills find themselves legally required to pay a price that the market will not let them recover. Now, the FRP is not too high in the abstract. It becomes too high the moment sugar prices drop, which in a chronic surplus economy is often. The cash runs short and the dues for mills pile up. This was the rhythm of Indian sugarcane for most of the post-liberalization era, and by 2017-18, it had produced Rs 22,000 crore in national arrears. Prior to 2018, the government had pumped nearly Rs 12,000 crore in direct subsidies over 8 years just to help mills clear their dues. So the government's answer was to give mills a second buyer for the sucrose in their cane. So in 2018, the National Policy on Biofuels was introduced. It pushed mills to convert excess cane into ethanol and sell it to oil marketing companies at a government fixed price. And then, as we covered before, this ethanol would be blended into petrol in cars. Now, this seemed like a reasonable fix for the arrears problem. Ethanol fixes it by giving the same sucrose a guaranteed buyer, oil companies paying a fixed government rate on a fixed schedule instead of a sugar market that might not cover what the farmer was owed. Ethanol fixes it not by adding new income, but by giving the same sucrose a different, more profitable destination. When a mill converts cane juice into ethanol rather than sugar, it sells the identical molecule to oil companies at a guaranteed price on a fixed payment schedule. The farmer still gets paid their FRP by a buyer who cannot walk away. Ideally, everyone wins. Between 2018 and 2023, blending rose from under 2% to over 14%. Oil companies were paying mills approximately Rs 42,000 crore annually for ethanol, and this flowed directly toward farmer payments, as evidenced by Maharashtra's dues falling to Rs 2 crore. But this fix was short-lived. Between 2023 and 2026, the combined impact of two decisions had dismantled the mechanism that had fixed the problem. The first decision was to keep raising the FRP. From 2022-23 to 2025-26, it rose from Rs 305 to Rs 355 per quintal, a 16.5% increase. This is what the FRP is designed to do, and it was a genuine win for the farmers. But while the raw material for the mills got more expensive, the procurement price for the ethanol that the mills produce remained unchanged. Their ethanol revenue didn't grow hand in hand with rising raw material costs. B-heavy molasses ethanol, the feedstock most directly tied to cane economics, has sat at Rs 60.73 per litre. Sugarcane juice ethanol at Rs 65.61. Undoubtedly, this led to some margin compression for the mills. The cost of producing ethanol from B-heavy molasses is estimated to be Rs 66 per litre, while the government pays Rs 60.73. Every litre of B-heavy molasses ethanol a sugar mill produces generates a cash loss of roughly Rs 5, causing a drain of resources from mills. The second decision was to bring grain into the ethanol program. Now, ethanol isn't just made from sugarcane, but also grains like maize and rice. To reduce the blending program's dependence on just cane, the government brought maize and surplus rice into the program. And the advantage of grain is that it can be processed year-round, unlike sugarcane, which is seasonal. And the government priced grain-based ethanol aggressively to incentivize this capacity. And because of this, a new player had entered the picture alongside sugar mills: grain distilleries. This would prove fatal for sugar mills and hence sugar farmers. In the first procurement cycle of the 2025-26 ethanol supply year, maize alone took 45.68% of all ethanol ordered by oil companies. In contrast, sugarcane-linked feedstocks combined took 27.5%. That share was over 90% when the program began. The ethanol program was thriving, but the sugar mills and farmers were being priced out of it while the grain distilleries were enjoying bumper profits. Maharashtra's arrears tell the story directly. Rupees 54 crore at the close of 2023-24 and rupees 2,130 crore at the close of 2025-26 per the Maharashtra Sugar Commissionate's fortnightly reports, a 39-time jump in 2 seasons. The 1996 order was written in an era where the word ethanol didn't appear in the vocabulary of sugar regulation. It governed one output, sugar. The industry had spent 8 years building a completely different kind of operation inside a legal container that had no idea it existed. That's what the Draft Sugarcane Control Order 2026 tries to fix. Its most significant provision is a new conversion formula for FRP calculations. 600 liters of ethanol from sugarcane juice, syrup, or B-heavy molasses will be treated as equivalent to 1 metric ton of sugar. Moreover, it allows district collectors to recover unpaid dues by attaching mill assets as land revenue arrears. That's a considerably sharper instrument than the interest penalty that existed on paper in 1966 and was almost never applied. The law also raises the minimum distance between mills from 15 to 25 kilometers. Now, the 600-liter equivalents will make a big difference to cane farmers. Unlike the old framework, a mill that diverted cane juice to a distillery would report a lower sugar recovery rate, reducing its FRP liability. And farmers would be penalized for the mill's production choice. The new clause imputes the diverted juice back into the recovery calculation, so the farmer is paid as if the sugar had been made regardless of what form the sucrose took. It closes an accounting loophole that did not exist in 1966. Since back then, there was no ethanol to divert juice toward. Now, even if the 2026 order can declare that mills are energy companies, it cannot make them profitable. That requires a CCEA notification revising ethanol procurement prices upward for B-heavy molasses and sugarcane juice. That notification has not come despite 2 years of requests from the Indian Sugar and Bioenergy Manufacturing Association, or ISMA, for a 50% procurement flow reserved just for sugarcane feedstocks. This would prevent grain distilleries from crowding mills out of a program that was designed to save them. 60 years after India built a legal framework to protect farmers from mills and watched mills fail to pay anyway because the economics never lined up with the legal requirement, the country is attempting the same move with ethanol. The FRP will keep rising. The procurement price for sugarcane ethanol needs to rise with it. Until things change, the 2026 law is a piece of regulatory architecture built around a financial proposition that loses money on every transaction it hopes to encourage. Now coming to the tidbits. The second round of negotiations for a free trade agreement between Canada and India aimed at boosting two-way commerce and investments started on Monday. The pact is officially known as the Comprehensive Economic Partnership Agreement, or CEPA, and negotiations will cover trade in goods, services, and other mutually agreed policy areas. Coming to the next tidbit. Gold prices fell by nearly 1% to rupees 1.5 lakh per 10 grams in futures trade on Monday, tracking weak global trends amid a firm US dollar and elevated crude oil rates. On the Multi-Commodity Exchange, or MCX, the yellow metal for June delivery declined rupees 1,149 or 0.76% to rupees 1,50,203 per 10 grams in a business turnover of 9,510 lots. Coming to the final tidbit. The rupee fell 39 paise to close at an all-time low of 95.23 provisional against the US dollar on Monday as the ongoing West Asia tensions caused volatility in global markets, keeping oil prices high and raising fears of inflation and economic slowdown. That's all the news I have for you. Thank you so much for watching and see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.